It's Thursday, 16th of July, 2026. Welcome back to your news update on Blip Brief, crisp, but almost everything updated every market trading day. The United States has just reimposed a naval blockade on Iranian ports. And look, the escalation here is moving at absolute breakneck speed.
It really is.
Overnight, U.S. forces disabled a third vessel right in the middle of the Strait of Hormuz.
Yeah.
And former President Trump is now explicitly threatening wider military strikes.
Yeah, he's on the record ruling out any deadlines before bombing Iranian bridges, which is
Which is a massive escalation.
exactly. And in response, Iran's foreign ministry is, holding a very hard line. They are stating their posture is strictly defensive, and they have absolutely zero plans for negotiations.
Right, so there's no diplomatic off-ramp in sight.
None at all. And the immediate real-world fallout is hitting the logistics and energy sector simultaneously. I mean, commercial aviation is scrambling.
I saw that major airlines are just rapidly canceling flights across the entire Middle East airspace.
Yeah, and the energy markets are reacting exactly how you would expect to a major choke point disruption. Brent crude oil futures, the global benchmark, immediately climbed 2% just on the fear of massive supply shortages.
2% overnight.
Right, and that is just the physical side of the disruption.
Well, because the squeeze on global energy is, it's actually a two-front war right now. You have this physical blockade in the Strait of Hormuz, but simultaneously you have a new U.S. bill threatening 100% tariffs on any country that purchases Russian crude oil.
Which puts buyers in a terrible position.
Exactly. So if you are an Indian policymaker or, say, a major refiner looking at your energy procurement strategy this morning, you are essentially playing a game of 3D chess on a board where half the squares are actively on fire.
That is a great way to put it.
I mean, your traditional Gulf route is a naval standoff, and your alternative Russian supply is trapped behind a massive wall of severe tariff threats.
Which is exactly why the maneuvering we are seeing from Indian refiners today is so incredibly strategic. They are aggressively shifting their reliance away from the Strait of Hormuz entirely.
How does that even work practically?
Well, instead of sending tankers deep into the Persian Gulf, they are pivoting to UAE ports that are located on the outside of the choke point, right out in the Gulf of Oman.
Okay.
We're talking about major terminals like Fujairah and Khor Fakkan. By sourcing crude from these specific ports, Indian vessels can just physically bypass the dangerous maritime choke point of the strait altogether.
I have to push back on that strategy, though.
Okay, go ahead.
Is physically bypassing the strait really enough to protect the Indian economy? Because listen, if the global benchmark for Brent crude spikes by 2% or potentially much more if strikes actually happen,
Right.
India still pays that higher global premium regardless of which safe port the oil ships from. I mean, the financial damage hits us either way, doesn't it?
Well, the financial damage hits, yes. You cannot escape price pain in a globally traded commodity market, but physical security of supply is exponentially more critical than price.
How so?
Look, paying a 2% or even a 20% premium for crude oil, that creates inflation. But physically running out of fuel because your tankers are trapped behind a blockade, that creates total economic paralysis.
So it's about keeping the lights on.
Exactly. India is prioritizing keeping the engine running over how much the fuel actually costs. But, and this is a big but, even with that bypass strategy in place, there is a massive, highly specific vulnerability that just securing crude oil does not solve.
You were talking about the liquefied petroleum gas supply chain.
Exactly. The LPG. India's LPG supply chain remains incredibly vulnerable here.
Because it's not the same as moving oil.
Not at all. Crude oil is relatively flexible. You can pipe it, you can load it onto various types of tankers from various ports. But LPG is a totally different beast.
Right, it needs this special infrastructure.
Yes, it requires highly specialized, cryogenic, and pressurized loading terminals. You can't just pump it onto a standard ship at Fujairah. And those specialized LPG export facilities, they are heavily concentrated deep inside the Persian Gulf.
So they are behind the blockade line.
Precisely. So even if Indian refiners secure crude from the Gulf of Oman, a full, prolonged closure of the Strait of Hormuz poses an immediate, severe threat to India's domestic LPG availability.
Wow. And, if you are looking at your household budget this week, those global energy premiums are already bleeding straight into your daily expenses.
Absolutely they are.
Which brings us to this really fascinating domestic inflation paradox we are seeing right now. India's retail inflation for June just printed at 4.38%.
Right, which officially breaches the Reserve Bank of India's 4% midpoint target.
Exactly. We are seeing rising food and fuel costs, which are, being exacerbated by very patchy July monsoon rains. And on top of that, wholesale inflation is creeping dangerously close to double digits.
It is getting hot. And yet, if you look at the macroeconomic consensus this morning, economists are broadly forecasting that the RBI is going to hold interest rates steady.
This is exactly the paradox I want to unpack.
Sure.
How can retail inflation breach the target? Driven by unpredictable monsoons and those global energy spikes we just talked about, while the markets essentially cheer and economists predict a rate pause.
It seems counterintuitive.
Totally. I mean, the markets aren't panicking at all. Tracking the broader Asian market rally, the Sensex closed up 0.17%, and the Nifty 50 closed up 0.11%.
Yeah, and the safe havens dropped.
Right. Safe haven assets actually retreated. Gold fell 0.77%, and silver dropped 1.08%.
Mm-hmm.
Now, the Indian rupee did close marginally weaker against the dollar due to some underlying safe haven demand, but RBI interventions kept those losses tightly capped. So unpack this for me. Why the optimism?
To understand this paradox, you have to look at how markets and central banks actually process time. Yeah, they are fundamentally forward-looking mechanisms. They are not trading on yesterday's patchy rain, right? They're trading on what the landscape looks like 6 months from now.
Okay, fair.
And right now, there are two massive safety nets catching the market's fall. One is global and one is domestic.
Let's start with the global one.
So globally, U.S. wholesale inflation just posted its biggest drop since April 2025.
Wow.
Yeah, that is a massive signal that the global inflationary engine is finally cooling down, and that means the U.S. won't be aggressively hiking rates, which instantly takes the pressure off the RBI to defend the currency with their own rate hikes.
Okay, that makes sense. And what about the domestic safety net? Because our local food prices are still a problem.
Right. So the domestic safety net is the agricultural timeline itself. Yes, June retail inflation hit 4.38%, but
it's just 1 month of data.
Exactly. The overall inflation trajectory for the entire first quarter was actually softer than the RBI originally projected. And more importantly, the central bank and the markets know that the Kharif crop sowing window is still open.
Right, the autumn harvest.
Yes. The Kharif crop is our critical autumn harvest, and it's heavily dependent on the monsoon. But that planting window remains viable all the way until mid-August.
So they have time.
Plenty of time. Investors aren't over...
It's just gone. And yet, the Indian IT sector displayed massive resilience today, completely shrugging off that shockwave.
It is a remarkable decoupling, honestly. Historically, the relationship is very linear, right? When a major U.S. enterprise technology client catches a cold, the Indian outsourcing sector gets pneumonia.
And not today.
No, not today.
I have to challenge this resilience narrative, though. If a foundational titan like IBM is crashing 25% in a single day, I find it really hard to believe Indian IT firms are genuinely immune.
It sounds impossible, I know.
Right, because if a major client is bleeding cash and market cap, aren't outsourced IT projects the very first expense they cut? How does Indian IT survive a structural collapse of that magnitude?
Well, you have to look at the why behind IBM's crash, because not all tech spending is the same. IBM fell into what we call the CapEx trap.
CapEx trap.
Yes, capital expenditure. Their crash is tied to massive, highly specific investments in artificial intelligence infrastructure. They are spending billions upon billions to build AI systems, but their enterprise clients aren't actually buying the AI software yet because they just don't know how to integrate it safely into their businesses.
Oh, I see. So IBM is spending money building a massive digital highway, but no one is paying the toll to drive on it yet.
That is the perfect analogy. Yes. It is a product and capital expenditure failure, not a broader economic collapse.
And Indian IT is doing something different.
Completely different. Indian IT powerhouses operate on an OPEX model operational expenditure. They are essentially the operational backbone for global business.
Right. The day-to-day stuff.
Exactly. They run the payroll systems, the cloud maintenance, the daily digital plumbing. They don't rely on speculative AI infrastructure buys. And they are actually seeing a tangible recovery in outsourcing demand this quarter.
Plus, Indian IT stocks have already endured a pretty protracted bear phase over the last year.
Right. They took their beating early.
So they were already discounted.
Precisely. That previous bear phase resulted in deeply depressed local valuations. And that low valuation acts as a very strong financial floor for their stock prices today.
So there wasn't much further to fall.
Exactly. They were already priced for a worst-case scenario, which gave them the margin of safety required to absorb the psychological shock of IBM's specific structural failures.
Which brings us to a company that did not have that margin of safety today. Patanjali shares tanked nearly 15%, despite management coming out forcefully to insist that it is strictly, quote, business as usual.
Yeah, the secondary market clearly does not buy that narrative at all.
No, they don't. But yeah, the overall liquidity hasn't vanished from the market. It's just moving to trusted assets.
Oh, absolutely.
So look at the SBI Funds Management IPO. This is a massive public offering, the largest of 2026, and the demand is just staggering. By day 2, it is already subscribed over 2.7 times over.
And if you dig into the data on that IPO, the breakdown of that demand tells a really crucial story about domestic wealth right now.
What's the breakdown telling us?
Well, the non-institutional investor segment, which heavily features high net worth individuals, is entirely leading the charge. They subscribed over 6.5 times their specific allocation.
6.5 times.
Yes. When you see high net worth individuals pouring that kind of capital into an asset management firm, it indicates a massive reservoir of domestic liquidity.
Right.
And that liquidity is actively looking for high-quality, trusted financialization of savings. And they are doing this while entirely ignoring the geopolitical noise in the Middle East.
And that domestic liquidity isn't just flowing into the secondary markets or financial services. It is funding the primary physical building blocks of the real economy.
The capex boom is real.
It really is. The Union Cabinet just cleared an aggressive multi-trillion rupee package for Semicon Mission 2.0, alongside a major new mobile manufacturing scheme.
Huge structural moves.
And at the same time, they approved a massive highway project budget, specifically designed to ease logistics congestion around Varanasi.
And the private sector is matching that aggression step for step. The Tata Group has just announced it is establishing its first ever shipbuilding venture down in Kerala.
Wow, Tata building ships now.
Yeah. And while all this domestic capacity is being built, the international trade corridors are actively opening up. The India-UK Comprehensive Economic and Trade Agreement, or CETA, officially kicked in.
Right, with a massive volume of goods shipped on day 1 alone. It feels like we are simultaneously laying down both the digital and the physical train tracks for the next decade.
That's exactly what's happening.
But help me understand the specific choices here. Why these specific projects? Why semiconductors? Why ships in Kerala? And why highways in Varanasi?
Because it is a deliberate, calculated transition. We are moving from being a service-heavy economy to becoming a hardened global logistics node.
Okay, but why now?
You have to look at the macro picture. China's economic growth for the second quarter just slowed to 4.3%.
Which is a 3-year low.
Exactly. And simultaneously, as we discussed at the top of the show, West Asian supply chains are becoming uninsurable choke points.
So India is physically building the capacity to absorb the global manufacturing overflow from China.
Yes, and doing it highly strategically. You build shipyards in Kerala because you absolutely need deep water coastal access to dominate maritime logistics.
Right.
You build massive highway networks around Varanasi because you need to connect the huge inland labor pools of the north directly to the eastern freight corridors.
It's all connected.
It is. And you pour massive capital into Semicon 2.0 because silicon chips are the new oil.
The new oil, yeah.
You simply cannot run a resilient nation purely on software code when the physical ships stop moving and the hardware supply chains break down.
That is a phenomenal perspective. And from hardening our national infrastructure, let's zoom out to talk about hardening our biological infrastructure.
This is the most exciting news of the day, honestly.
It really is. There is a staggering scientific breakthrough making waves today that could fundamentally change human longevity. Scientists have just discovered a new brain cell structure that they're calling a hidden gatekeeper.
Incredible.
And it could be the secret to halting the progression of Alzheimer's disease entirely. Break this down for us. What exactly is a cellular gatekeeper, and how does finding one fundamentally change how we treat cognitive decline?
To really appreciate how massive this is, you have to understand how we currently fight Alzheimer's. Historically, we know the disease is driven by toxic proteins, right? They build up in the brain and they destroy neurons.
Right, the plaque buildup.
Exactly.
Yeah.
So up until now, medicine has essentially been running around inside the brain trying to clear those proteins out after they have already accumulated.
Which seems too late.
It usually is. Or they're just trying to manage the cognitive symptoms once the structural damage is already done.
Right, so we're just trying to mitigate the damage of an invasion that has already happened.
Exactly. Now imagine the most vulnerable part of the brain's network as an exclusive nightclub.
Okay, I like where this is going.
For decades, drug therapies have been acting like security guards running around inside the club, right? They are trying to kick out unruly guests, the toxic proteins, after they have already trashed the
Oh,
place.
not a great strategy.
No, but this new discovery is like finally locating the bouncer at the front door.
Oh, wow.
Yes, this hidden gatekeeper is a structural element at the cellular level that actively regulates what enters the brain's network in the first place.
So it changes the target of the medicine entirely. You aren't fighting inside the club anymore.
Completely. By targeting this specific gatekeeper, researchers are opening up entirely new pharmacological pathways. The goal shifts from treating symptoms inside the brain to fortifying the cellular bouncer right at the perimeter.
That makes so much sense.
They believe they can fundamentally change the VIP list, basically stopping the toxic proteins from crossing the threshold and entering the vulnerable areas of the brain at all. It's incredible. It fundamentally shifts the approach from damage control to absolute prevention.
It really does.
And it makes you wonder if our own biology has these built-in gatekeepers we are only just now discovering. What other hidden biological choke points are we completely overlooking in the pursuit of human longevity? I mean, it really reframes how little we still know about the human machine. And just before you go, a quick note, this deep dive commentary was put together using advanced AI. We always strive for accuracy, but please do cross-verify any crucial information yourself. Your informed decisions are what matter most. The content shared here is for informational and educational purposes only and should not be treated as investment or trading advice. Past performance is not indicative of future returns. We are not licensed financial advisors.